CME Group launched Micro E-mini Futures Contracts. Discover how a smaller Micro E-mini Futures Contract opens the world to greater trading possibilities.
Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Excited to be here, Jeff.
Well, Bob, it's hot here in Chicago, and it's hot in the market. We're seeing the S&P 500 surge to new all-time highs subsequent to the G20 meeting. Tell me what your thoughts are here in this moment.
Well, it's in part the tariff truce, I should call it, and it's in part the optimism that the Fed is going to cut rates. CME Fed Watch tool still has a 100% probability of a rate cut this year.
So the Fed meeting later in the month, is that where all the eyeballs are right now in the market?
Yep, more easy money for stock buybacks, and then again, if we get a deal, off to the races.
Understood. Great point, Bob. Let's get into this first lightning round.
Let's do it.
10-year note yields. Well, we saw the 10-year note yield just plummet in Q2 of 2019. Dipped under 2%. Will it stay under 2% here, Bob?
I don't think it can if the Fed is actually active. So what I'm looking at as an example to take advantage of that is I'm selling the week 2, July 180, 128.5, 130 call spread in the 10-year note. I'm selling the 128.16, some of you call it the 128.5 call, week 2 in July to collect 210 and buying the week 2 130 call for $20.
Well, this makes a lot of sense. So you're going to potentially collect about $190 on this call spread. In your thought process here, correct me if I'm wrong, Bob, but you don't see the 10-year spending much time under 2%. Therefore, selling this call spread will watch these yields move higher and the price of those futures go lower.
Totally agree. And the at-the-money vol is about 453. The underlying futures contract, 128.08. That high is probably going to be a ceiling that the Fed is not going to let it go through.
No, great point. Remember, those were the SEP futures with the underlying futures contract for this trade example. And do remember that these are trade examples, not trade recommendations, please. Let's move to the second lightning round, pal.
Let's do it.
Fed rate cut. Well, you hit the nail on the head earlier. And certainly the sentiment in the market has really moved these markets higher to new all-time highs. We talked about the E-mini S&P 500, but let's talk a little bit about the NASDAQ. I know we have earnings season not too far out, but the NASDAQ continues to be the sector to own in 2019.
Yeah, it really does. And if we get a reversal, the NASDAQ is going to struggle quite a bit more than the other indices, in my opinion.
Well, we talk about a lot of different option examples here on Striking Options, but the risk reversal option example I want to use today allows an investor potentially to mitigate downside risk. So I'm buying the week 2, that's July 12th expiration, buying that week 2 7,500 put in the E-mini NASDAQ, but I'm also selling the 8,000. So this risk reversal allows me to sell that 8,000 call for about 8 ticks or $157. But I have to spend a little bit more money because that put at $7,500 is only about 2.5% away. And this is a short time decay situation with this risk reversal, Bob. So at the end of the day, it's not costing a lot. But in the event we do see tech relent, this is a way to approach it.
Yeah, and again, vol is falling right now because, again, of this J. Powell put that the market thinks is in play. Another way to look at this is to look at the micro E-mini NASDAQ futures, which are a low-cost way to just go outright short or even hedge this particular trade.
Well, that's a great point you bring up. And as we see, July 15th, the banks will be kicking off earnings season, tech subsequent the week after. So those micro E-mini NASDAQ, that allows you to approach a downside move or an upside move, correct?
It does, and I don't want to dismiss the vol falling. I mean, 1383 on these July 12th options, that's a falling vol level.
Well, and lastly, that's a reason why we want to own these puts because of the inexpensive nature of that falling volatility. And the SEP futures in this trade example were trading at $77.99.50 when this was priced out, Bob.
Yeah, and I like the target of this as well because you're going to get some support around 7,400.
Well, thanks as always for coming on Striking Option, Bob, and please tune in every week as we will continue to strike options.